I'm Dennis Tubbergen. This is the Retirement Lifestyle Advocates radio program. Glad you decided to tune in today. Hey, I caught up this past week with Mr. David Skarica, the publisher of the Addicted to Profits newsletter. In the second and third segments of today's program, I'll share that conversation with you. We talked about where he thinks inflation is going, the value of stocks and other asset classes. You won't want to miss this conversation and get his take on where we're headed from an investment perspective. You know, my report that I have published for the month of April asks the question, are we rocketing toward reset? Stock valuations, as we'll talk about, are at all-time highs. We're seeing what can only be described as extreme craziness in the real estate market. And you have to ask, are we rocketing toward reset? And what are you doing to protect yourself? And the report will actually give you my assessment of where things are and give you some strategies to consider to protect yourself. If you'd like to get a copy of this report at no cost, it's available for this month only. Go to requestyourreportnow.com, requestyourreportnow.com, and not only will you get the report, you'll get some other free resources that we will ship to you. Just give us your name, let us know where we should mail those resources, and we'll be very glad to do so. Again, the website, requestyourreportnow.com. You know, we ignore what many of our founding fathers said, certainly to our detriment, in my view. Now, Thomas Jefferson, whom I have quoted often here on the radio program, said, if the American people ever allow private banks to control the issue of their currency, first by inflation, then by deflation, the banks and corporations that will grow up around them will deprive the people of all property until their children wake up homeless on the continent their fathers conquered. Now, essentially, Mr. Jefferson said, don't let private bankers control the issue of your currency because you'll have inflation, then you'll have deflation, and the bankers will essentially destroy the country. That's my paraphrase. Now look around. Tell me that that is not exactly what we are presently seeing. Now, for those of you that are new listeners or perhaps don't delve into monetary issues to a great extent, the Federal Reserve is a private bank. Back in 1913, Congress and then President Woodrow Wilson thought it would be a good idea to give private bankers control over the issue of our currency. And like many things that happen in Washington that the politicians don't want a lot of attention drawn to, this law was signed into law at the Christmas break in 1913. In fact, if you want a little historic trivia, 1913 was a bad year, in my view. It's when the income tax became reality, and the Fed did as well. Now, on past radio programs, I've talked about what the real inflation rate is. Now, those of you that have gone grocery shopping, those of you that have been to the doctor, those of you that have bought lumber, you know that this inflation rate of less than 2% is certainly not reality. See, the official inflation rate is measured by the Consumer Price Index, and that calculation is heavily manipulated to present a headline number to the public that appears innocuous. In calculating the Consumer Price Index, there's adjustments made for hedonics and weighting and substitution. I could talk a whole segment on that, but let's just say there is a manipulation that goes on. Now, there are a lot of privately administered inflation indexes that, in my view, do a much better job of relating to us, the consuming public, what the real inflation rate really is. I've interviewed John Williams of shadowstats.com. Mr. Williams is a brilliant economist who tracks economic data using methodologies that the government used to use. According to Mr. Williams, the real inflation rate, if we calculate inflation the way we did in the 1970s, runs about 10% per year. That feels more normal, doesn't it? And Ed Butowski of the Chapwood Index would estimate the real inflation rate to be somewhere between 8% and 10% annually, depending on what part of the country you might live. Mr. Butowski used what I think we would all agree is a very common sense approach to determining what the inflation rate is. He got on Facebook and recruited volunteers in the 50 largest metropolitan areas in the country, and every 6 months he has them go out and price consumer items. So that 8 to 12% number that Mr. Butowski's Chapwood Index comes up with takes a look at inflation based on what it costs for movie tickets, takeout pizzas, and haircuts, and things that all of us buy every day. So arguably, going back to what Mr. Jefferson said, we are seeing inflation. Remember, Mr. Jefferson said that if we allow private bankers to control the issue of our currency, first by inflation, then by deflation, we're going to have problems, to paraphrase. Now, how much more inflation we see is extremely difficult to quantify, and it's going to be based on what policy decisions the Federal Reserve makes. Now, at the same time this money creation is going on, debt levels in the private sector and the public sector are at nosebleed levels. Now, this is one of the reasons the April report is titled, "Are We Rocketing Toward Reset?" And if you're just joining me, I'd love to send you a copy of the report for free. You can go to requestyourreportnow.com, and I'd be glad to send it to you. Now, when debt levels are unsustainable, as I believe they are presently, at some point the debt will have to be dealt with. That's when deflation kicks in and asset prices collapse. And here's the ironic part. The same easy money policies that help to stave off deflation to this point are the very reason debt levels get to unsustainable levels. It goes to the core of why money is created to start with. It's created to stave off deflation, which are caused by excessive debt levels. Now, certainly when you look at asset levels presently, particularly stock and real estate, you find that these asset classes are more overvalued now than at any time in the future. Now, Warren Buffett's favorite stock market valuation metric, something that is now known as the Buffett indicator, is basically market capitalization over gross domestic product. It's a fraction. And when you take the total value of all stocks, which is really how you define market capitalization, and you divide it by economic output, which is how you would define gross domestic product, you find that stock levels have never been this high. Stocks have never been this expensive. And as I'll talk about in the next segment with my guest, David Skarica, there are many other stock valuation metrics that would lead you to the same conclusion. Stocks are simply overvalued. Real estate prices also at record high levels, and as I said at the outset of this segment, the real estate market is nothing short of crazy. The Case-Shiller Index, which is the most commonly used index when valuing real estate, shows that real estate prices, like stock prices, are more overvalued than at any time in history. And in the last segment of today's program, I am going to share with you what a federal agency has warned mortgage firms about just last week. They're predicting a wave of foreclosures this fall. I'll talk about that in the last segment of today's program. Now, if you're just joining me again, this month's free report is titled, Are We Rocketing Toward Reset? It takes a look at asset levels, asset prices, and shows how they're set up for a reset and gives you some strategies that you might consider using as well. To get your copy of the report, go to requestyourreportnow.com. requestyourreportnow.com. We'd be glad to send you a copy. I will be back after these words with Mr. David Skarica. I'm Dennis Tubbergen. You are listening to RLA Radio. I'm joined again on today's program by Mr. David Skarica. David is the publisher of the Addicted to Profits newsletter. You can learn more at his website, addictedtoprofits.net. The website, again, is addictedtoprofits.net. So, David, welcome back to the program.
Thanks for having me. Yeah, it's good to be here again.
So, David, let's just jump right in. We have had here in the United States a couple of years with just record money creation. It appears that we're starting to see some inflation. What's your take on that?
I think they want inflation. You know, the Fed, first of all, I'm one of these people, I think those inflation numbers are pretty Orwellian and, pretty much BS. There's actually a cost of living index they have, just before we get into this, to talk about having inflation. That shows what the cost of living is like in cities. And if you go look at this index, it's like most cities, the cost of living is going up, and this includes everything, housing, from expenses, food, et cetera, is going up 10 to 11% a year. So, even if that's maybe a little over the top, I think we're definitely more in the 5 to 10% range than we are the 2 to 3% range. So I think that's an issue. But on their inflation numbers, the Fed has basically said they're willing to go well above the 2% target, the 3%. So they kind of want inflation, and partly because all the debt that individuals, corporations, the governments have all taken on, and kind of these bailouts of the economy during COVID. I think the only way to kind of get out of this is really to inflate it away. So they essentially want inflation at this point. And, we're seeing it it looks like might be starting another major bull market here in commodities. Because, during the 2010s, we really didn't, we saw the markets go up and asset prices go up. We didn't really see commodities go up. They peaked mostly in 2011 and, after a strong 10-year bull market. And now we're seeing, oil and gas is back up over 60. Agricultural commodities are rallying in price. Like lumber has been rallying, a lot of rare earths because of the push towards electric vehicles are rallying. Even looks like today we're talking gold is getting right to its resistance level of 1750. And if that goes up, it looks like gold might resume its rally that began last year. And we've been kind of in this 7-8 month consolidation. And, silver's back north of 25. So maybe those are finally starting to move too. So I think, we're seeing this kind of push for inflation. I think ultimately it'll probably lead to some kind of stagflationary trade. And of course, one thing that we don't know is that right now we're kind of on the cusp in terms of when higher rates become problematic. As of now, this pushback in the 10-year to 170, that's not totally hurtful. The government can still, even with these high debt levels, support that. I think once you get into 2.25 to 250 range on the 10-year, the debt is so high, they're going to run into some fiscal problems, in terms of interest expense. And of course, that pushes up rates for everything like corporate bonds, junk bonds, et cetera. So I think that's when the debt levels could be problematic. And by the way, that's when we could see massive inflation, because I think once the rates get to a certain level on the long end, the Fed will do what's called yield control, and they'll start buying the long ends to keep, because one thing about these, to keep the long end down, right? Which is really, really inflationary. Because one thing about the long end going higher is that if you go look at, for example, the 3-month T-bill, it actually in March went negative for a few days, the yield. So the short end rates aren't really being pushed up, but it's just the long end that is. And one thing about the government debt, a lot of the government debt is 2, 3, 5-year maturities. So really that pushback on the long end hasn't affected it as much as I think. I think where the problem is going to become is that one thing always surprised me last year when they issued a lot of debt for the first stimulus, they did it in a lot of 2-year, treasuries. Well, that means those are going to roll over in 2022. And with, the even more spending that Biden is doing via stimulus and Green New Deal and infrastructure projects, you're going to see even more debt issued over the next year. So then you're going to have to roll over those trillions in 2022. So I would think at some point they're going to want to roll over this debt into longer maturities because they're going to have so many, every year they're going to have so many 1, 2, 3-year maturities rolling over. Again, that could put pressure on rates at some point. And what's scary about the economy as a whole, like I said, at consumer, corporate, and government levels, is that we can't handle these, like even, in this last cycle, the top in rates was like 3.5% or so on the 10-year bond. We can't handle that now. Like, I'd say over 2 is when we're going to start running into problems. So, and of course, this is at a time when debt is completely out of control. I think we're in a debt bubble too. Because now, when I started in the markets, the thing that got me interested, and one reason I became kind of a gold, hard metal, hard asset guy, is because, in the early 90s, people were getting worried about the debts, kind of what one of the things Ross Perot ran on. And, talked about, the debt maybe getting out of control. And now no one cares about that, even though the debt is 7 or 8 times higher than it was in the early 90s. And, so now it's just like, another 2 trillion here, another 2 trillion there. And, when the U.S. economy is about 20 trillion in size and the national debt's going to get above 30 trillion, that's 150% of GDP. We're talking that's banana republic, fiscal basket case levels,
Yeah, and David, when you look at debt levels, when you look at deficits over the past couple of years, and you look at this blatant disregard for fiscal responsibility, among all this, we have these theories emerging, like modern monetary theory, where hey, it doesn't matter how much money the government really spends because they can just create it, and if they create too much and there's too much inflation, they can just raise taxes and suck the money back out of the system. What's your take? I mean, it's kind of my view that, these theories arise because there's no other way to explain it away.
Yeah, well, I think that, it's just like, I think one reason these theories have arisen, maybe it's an offshoot of the fact that debt level is already so high, right? Like, for example, if you wanted to become more socialistic post-World War II or in the 50s and 60s when the economy was really booming, and I know the debt level was high after World War II, but we all know that was a one-time expense to pay for the war, and, gradually came down. Like, I think in the mid-70s, that's when it reached the post-war bottom, and it was like, like 33, 34% of GDP. You could actually say, oh, we want to become more socialistic. And actually, a lot of Western European countries and Canada took this route back in the 70s. And they did it mostly by actually raising taxes, or having higher taxes at lower income levels. They basically paid for it through taxation. They're like, well, you want universal health care, we're going to pay for it through taxation. Well, now the debt level is so high, I think an offshoot of that becomes, well, taxation isn't going to pay for it because, we have some ridiculous $4, $5, $6 trillion deficit, So the way you can kind of explain it away is, oh, why don't we just print the money? And because they did print so much money after the financial crisis, even the last year, and the currency has not fallen apart, they can kind of say, oh, see, it won't cause hyperinflation. And it is true because of the dynamics of the U.S. economy. It's still going to be the reserve currency for a little while longer. You probably won't get Venezuela-style inflation. And by the way, there's very unique one-offs in Venezuela that has caused that inflation, like partly because the economy was so dependent just on oil, right, which the United States does not have that issue, right? So it's got a much more diversified economy. So you're not going to get that. But, I think at some point it does, reality has to take hold. And you're going to get this massive inflation. Remember, one thing that we don't talk about now, we just talk about stimulus and this, and maybe there's one reason they want modern monetary theory too, is that, remember, the baby boomers are all about to retire. So that means more Social Security, more Medicaid expenses, Medicare, et cetera, more outlays. And that's on top of all these short-term things they're doing because of COVID. And the thing about these stimulus checks, actually what's bigger than the stimulus checks, I think, is the inflated unemployment checks. Remember, people are getting, inflated state unemployment more than they usually would, and for longer than they usually would. It's kind of like income tax in 1913. When a government program like that gets instituted, usually it just they say it's temporary, but then it becomes longer term. So I think that's what's going to happen with a lot. You talk about MMT and universal basic income. That's essentially what these inflated more again than even the stimulus checks. The inflated unemployment benefits are really a form of UBI, right? And if that becomes permanent, then you're just going to have to essentially print money for that. Because, for example, if you give everyone a $1,000 or adult age people a $1,000 a month stimulus check, I think that costs about $4 trillion a year. Ray Dalio did a study showing that, and $4 trillion a year is essentially what the government budget was pre-COVID. But pre-COVID, the government was spending about $4 trillion and collecting about $3 trillion in taxes, and so you're essentially doubling the government budget. In normal times. So where's that money going to come from? You can do some additional taxes, but really, if you're going to double the government budget from $4 trillion to $8 trillion, you're probably just going to have to print a lot of that money. And I do think at some point it does matter. You can't have 1,000% of GDP debt. That's just not going to work. So at some point, the bond vigilantes come back, rates go higher, and actually forces some kind of austerity, in the country. But probably you have some kind of inflation before that occurs. And remember too, there's also other dynamics. A lot of people will say, well, look at Japan. They have all this debt. They printed all this money in the last 30 years, and they've had problems with deflation. But an issue with Japan is two things that's a lot different than the United States. Number one, their debt is almost all domestically owned, so they don't have to worry about foreigners dumping their debt. And then number two, Japan kind of subsidized their budget deficits by running huge trade and current account surpluses. The United States does not do that. So that's another factor as well. That's one reason, because Japan just makes a lot of stuff, even with China coming on and replacing them for a lot of exports or imports to exports to the States, imports from there. Japan still makes a lot of cars and electronics and other things as well. So, I just think that, the Venezuela, I think we're somewhere in between Venezuela and Japan. We're not going to get a deflationary bust, and we're not going to get that super, super duper hyperinflation, but we could definitely see a form of stagflation with the real inflation rate being higher than probably those inflation rates of the 70s. And part of it, too, will be not just, again, to pay for stimulus and Green New Deals and, infrastructure. Part of it will be because you'll have a bigger structural deficit because the baby boomers are going to retire and all the money that's going to spend. We know that a lot of those pension plans and whatnot are unfunded liabilities.
Well, my guest today is Mr. David Skarica. He is the publisher of the Addicted to Profits newsletter. You can learn more at addictedtoprofits.net. I'll continue my conversation with Dave when RLA Radio returns. Stay with us. I'm Dennis Tubbergen. You are listening to RLA Radio. I'm chatting today with returning guest, Mr. David Skarica. If you're just joining us, David is the publisher of the Addicted to Profits newsletter. You can learn more at his website, addictedtoprofits.net. And David, you used the term stagflation a couple times in the last segment, and there may be some listeners out there in our audience that maybe are not familiar with what that looks like and how they might be affected. Can you dig down on that a little bit?
Yeah, like the basic, the normal economic theory before the 1970s was inflation actually would happen during booms. What would happen was there'd just be a lot of demand for, say, goods and services, and that would cause their prices to go up because, let's say, the economy's booming, everyone's got jobs, wages are going up, then people, everyone wants to buy a new car, everyone wants to buy a nice new house, and they would push the prices of those things higher because of demand, right? So they really thought inflation was a demand problem. But what happened in the 70s was you had supply shocks, with the OPEC crisis in both 73, 74 and in 79, 80. And then so that means like less oil was on the market. And then also you had all this monetary printing of money to pay for, the new society by Lyndon Johnson, and then for the Vietnam Wars, et cetera. The deficits were increased for a while there. So then you had this kind of like what's called stagflation, where like because of monetary measures and supply stocks, you had inflation going higher at a time when the economy was doing poorly, like in a recession, unemployment going higher, which showed that inflation actually, Milton Friedman said that inflation is and always has been a monetary phenomenon, meaning, they're printing too much money for whatever reason, and that money sloshes around the economy. So stagflation would be like after I think we see this initial bump in the economy because things are opening up. There is, a lot of pent-up demand, because people haven't been able to go anywhere, do anything. The people with money have savings. So I think after that kind of initial little mini boom, and then the government's going to kind of like, basically max out its credit card. That's one problem with these stimuluses too. They're doing it during this little recovery we're having it. And then if we drop back into recession, well, what are they going to do? Right. So I think that once you get through this little mini boom, you will see, maybe another, I don't know if it will be a W or at least a slowdown in the economy again. And then again, when if the market goes down, if prices start to go down, if whatever it may be, they're going to have to print more money to try to prop everything up again. So then you could see prices go right back up, but the economy not recover. And that would be stagflation, that, inflation is going higher, but the economy is still weak. And I think we're kind of seeing a form of it now because, that we all know that unemployment rate of 6% is phony. The participation rate is at like multi-decade lows. The real unemployment rate is probably in the 10 to 15% range. So we're kind of seeing a stagflation now where, prices of homes have gone up a lot because there's a geographic shift going on. People want to get out of cities and they want to get into suburbs or just get out of states and move to certain states, move from California or New York or Michigan to Florida or Arizona or something like that, right? So we're seeing we're seeing this kind of shortage of goods in some areas and prices go higher, but at a time when the economy really isn't that great. So that's really what stagflation is in a nutshell. It's prices going higher, but the economy is still weak or in recession.
So, David, let me shift gears a minute because you mentioned that in the last segment, I think your comment was the U.S. dollar will be the reserve currency for a while longer. But there was some reports out this past week that the U.S. dollar as a share of foreign reserves is actually declining. Part of that is due to the fact that dollar relative to the yen and other currencies, doesn't buy what it did, even 3 months ago. But part of it is that there's foreign governments dumping U.S. dollar-denominated holdings. So how long do you see the U.S. dollar remaining a reserve currency, and what reasonable alternative might there be in your view?
I don't think they're dumping so much. Most of the stats are showing that they're actually just not buying, right? They're just if you look at Japan and China's foreign holdings, really they're not going down a great deal. But with all the money being created all over the place, if you don't buy anything and the money supply is up 20%, well, then your U.S. dollars of the total, say, global money supply go down 20%, right? So it's really, I think because of the measures that are being taken with the excessive debts, and the U.S. is being, by the way, way more aggressive on a per capita front than most countries. We tend to think Europe is more socialistic, but if you go look at a lot of the European countries in terms of bailouts, like stimuluses, et cetera, virtually no one's going to do an infrastructure thing the way the U.S. is, or it's going to be much smaller as a percentage as the GDP. Anyhow, so I think that's part of the thing. I don't know. I can't see the yuan just taking over. It's still kind of a linked currency. It's not liquid. Most of us don't believe the numbers out of China. So I could see like a basket of currencies with the U.S. dollar even being part of that, where maybe you've got the yuan, the euro, the US dollar, even a couple of the big emerging markets, countries which are growing quicker, like, the rupee and Brazilian real, things like that, maybe mixed in with some gold and precious metals. I could see that sort of thing kind of taking over, more like a basket than just a one reserve currency. Because what you have to understand too is globally, I don't know if people want the yuan to be the reserve currency, because if you go look at the reserve currency for the last 400 or 500 years, it's gone from really Western Europe to the U.S. Like, we had, because for a while, Portugal, the Holland, France, Spain, UK, they were all the superpowers of the world and essentially had reserve currencies for a time. And then it moved to the American dollar after World War II. So I don't know if people really want like an Asian superpower, especially that one is not, a democratic nation and could potentially use that reserve currency status to spend money to build up a military that could be, not so friendly. So I think that it's really going to be a mixed basket of these currencies. I know a lot of people think crypto will replace it. I think what's actually the move in crypto is going to be more to these government-backed cryptos that are going to be used for payment systems and the whatnot, rather than these little private exchange. Actually, the private ones might get regulated and cracked down on. So I think that more likely it's going to be a mixture of that, and maybe we'll see like a new agreement, like a Bretton Woods type thing, where gold is getting kind of frozen, gold is frozen at a certain price, but it'd be a much higher price here with all the money in circulation around the world. But I could definitely see a mixed basket of currencies. And maybe because U.S. is being so reckless fiscally right now and really taking advantage of its reserve currency status. And that happens to a lot of these countries, but like, if you go look at the UK never went crazy spending on domestic programs, or they more had like the empire, and World War I and World War II had essentially bankrupted them. So I think that now when if you've got a bunch of very woke, political correct programs being paid for by cheap money that can be issued on a reserve currency status, I think that a lot of foreign investors won't go for that. And I think when they get together, they might say, well, let's do something to prevent this. Let's prevent this from, a reserve currency being dependent on one country if they become fiscally kind of reckless. And maybe a basket of currencies mixed in with precious metals will be a way to, sort of do that. And I don't know, some people wouldn't like that because they might think that's a one world currency, but I'm thinking more of it's just like a basket where, like a government might have 20% of their money in the US dollar, 20% in the euro, 20% in the yuan, 20% in gold, etc.
Well, David, we've got about 1.5 minutes left in this segment. Assuming something like that happens, what do you think that does to gold prices or gold and silver prices? And that aside, what's your forecast for precious metals moving ahead?
I really think what we need in gold and silver is what I talked about earlier in the show, is the yield control. I think right now, again, with this rebounded economy and then these booms in other asset markets, stock market's done great, collectibles are booming, cryptos are booming. That kind of is taken away from the quote unquote fear trade where people move into gold when they're worried about things going bad. And like I said, we are going to see this mini blip or recovery in the economy or boom in the economy, for the next 3 to 6 months, that sort of thing. So I'm longer term, I'm very bullish on gold because of all the printed money. But I think what needs to happen is, I think before we go into some kind of really kind of aggressive inflation or hyperinflation style, or stagflation, like I talked about, really, I mean stagflation with the economy again going down and prices going up rather than this little recovery. I think we'll need a bust in the stock market, and we're more like most overvalued we've ever been in the market by almost every historical measure, right? So I wouldn't be surprised if we see a 1987 or 29 type shock at some point. You can never time those things, it's impossible because of the massive overvaluation. And I think the response to that will be even greater money printing, probably even buying ETFs to try to prop up the market, et cetera, right? So I really think that is what's needed for gold to really significantly move higher. And I don't know if you did like the Dow to gold ratio, which usually meets at 1-to-1. In the 30s, they met at basically 35-40, 1-to-1, because I think the Dow went to 48 and gold went to 35. And then 1980, they met around 800. I don't know. I would think that after initial bust, the stock market will rally because they'll be printing so much money, inflation, everything go higher. So I don't know. They can meet at 20,000, 25,000, but that would be like my ultimate thing. But as a warning, when that happens, if you go look at a gold chart of 79.80, it will probably be a last parabolic move. Gold will probably slowly move higher, to whatever, 5, 6, 7,000, something like that over a few years, and then do that final kind of blow off at that point as well. So, but yeah, I would definitely think, I know that sounds crazy, but if you go look at all the printed money, the fact that will be more printed money after the next bust, yes, I'm more interested in the Dow to gold ratio than actually predicting a gold price. I do believe in that 1-to-1, essentially at a top for gold and bottom for the Dow. So it's just the question is, if it's the bust is a little more deflationary, it would probably be 5 or 10,000, which would still be a great move for gold. Plus, the cost of all the miners and production would be going lower, so their margins would be great. And if it's more inflationary, which I would lean towards, who knows? It could be 20, 25,000, 30,000. It could be $1 million, if they print enough money. But yeah, that's kind of what I'm looking at. Basically, significantly higher. And I do believe that in 2016 we hit a low for gold in this cycle, and then we kind of based for a few years. And really, 2019, 2020, we kind of saw the first move up. So, we're only, I would say, we're kind of where we were, saying 2002 in the last bull market, which lasted basically from 99 to 2011. So we're probably only in I'm going to use football analogies. I'm more a football guy than a baseball guy. Well, we're probably somewhere in the mid to late of the first quarter. We're pretty early on here.
Yeah. All right. Well, we're going to have to leave it there. My guest today has been Mr. David Skarica. His website is addictedtoprofits.net. I'd encourage you to check it out. And David, thanks for joining us today.
Thanks for having me.
I will be back after these words.
This is RLA Radio. I'm Dennis Tubbergen, your host. Glad you decided to listen in today. And thanks again to Mr. David Skarica for joining me on today's program. I opened the show today by talking about a Thomas Jefferson quote, essentially a warning. And Mr. Jefferson warned us that we should never allow private bankers to control the issue of our currency because, first by inflation, then by deflation, we'll have economic problems. And as I said, that seems to be exactly what we are seeing. And while the headline inflation rate is holding at less than 2%, we all know that the real inflation rate is higher than that. And I gave you a couple examples of some private inflation indexes that would estimate that real inflation is running between 8 and 12%. So inflation occurs when we have excess money creation. But when does deflation occur? Deflation occurs when money disappears from the financial system. Well, how does that happen? Well, when there's too much debt in the system and there's too much debt to be paid, because debt is money, when debts go unpaid, we have deflation and we have a significant collapse often in the price of assets. And I talked about the fact during the first segment and with David Skarica today that when you look at stock prices by almost any metric, stock prices are more overvalued than at any time in history. Real estate prices have followed suit. Now, I believe that we're going to see the real estate market, and this is simply my perspective, I think we're going to see the real estate market turn negative by the end of this year unless some form of artificial support is used to intervene in this market, or maybe if mortgage forbearance programs are extended further, we can kick the can down the road a bit more. Last week, however, a federal agency, the Consumer Financial Protection Bureau, warned mortgage firms to take all necessary steps to avoid a wave of foreclosures this fall. Here's a bit from an article that was published on Zero Hedge. The Consumer Financial Protection Bureau warned mortgage firms Thursday to, quote, take all necessary steps now to prevent a wave of avoidable foreclosures this fall. As of March 30, 2.54 million homeowners remain in forbearance. That's about 4.8% of all mortgages. Look around your neighborhood. Check out all the houses as you drive home from work or from the office. 1 in 20 homeowners are in a forbearance program. Now, the director of the Consumer Financial Protection Bureau said this, quote, there is a tidal wave of distressed homeowners who will need help from their mortgage servicers in the coming months. There is no time to waste and no excuse for inaction. No one should be surprised by what is coming. That doesn't exactly sound like a vote of confidence in the real estate market. Now, what is a forbearance program? Well, forbearance is when your mortgage servicer or your lender allows you to pause or reduce your mortgage payments for a limited time while you build back your finances. Here's the key point, though. These forbearance programs don't forgive any payments. You're obligated to pay back payments as well as current payments. Now, how many of these distressed homeowners, when faced with this reality, are just going to walk away from the house? Some may be able to refinance. Some may have their forbearance program extended. But it's likely that, like happened more than 10 years ago, about a dozen years ago, I should say, many of these homeowners will just walk away. Well, what will that do? How will the real estate market be affected? Well, it's got to turn the real estate market on its head. So, at some point in the near future, we're going to have to see assets repriced. My guest on today's program agrees and said the same thing. Now, when it comes to stocks and managing the money in your IRA or 401k, I would proceed with caution. I'd have a plan in place to avoid drawdown. And if you'd like more information or a different perspective, just request my free April report titled, Are We Rocketing Toward Reset? You can get the report by visiting requestyourreportnow.com. Requestyourreportnow.com is the website. And maybe if you're thinking about selling real estate, doing so soon is something you should consider. And the opposite side of the same coin might have you considering taking a bit of a pause before you buy and wait a bit to see how this plays out this fall. There's always the possibility that you'll find your dream home for a much lower price. Of course, everything I'm talking about today hinges upon how much money creation the Fed actually engages in and how much inflation we might see before the inevitable deflation kicks in, as Mr. Jefferson told us it would. If you don't yet have the RLA app, you can go to the App Store on your smartphone, search under Your RLA, that's YOUR-RLA spelled as one word. You can get the app for free. The app will get you access to all of our free resources, including the podcast version of the radio program, our weekly Portfolio Watch newsletter. You'll also get access to our weekly Headline Roundup webinar, where we take a look at the news from the perspective of you and your finances. We're getting terrific feedback on that. So again, the app is available at the App Store. Search under Your RLA, all spelled as one word, and you can download that app for free. That's all the time I have for this week. I will be back again next week. Hope you have a great week.